The stock market looks expensive by almost every metric. PE ratios, the Buffett indicator, even market cycles. And the last major crash was just 4 years ago. So the question isn't if the next bear market is coming, it's how you position yourself before it does. Now, none of these indicators are perfect on their own, but when you line them up together, they start telling a pretty consistent story. On a broad level, PE ratios across the market are elevated compared to historical averages. That doesn't guarantee a crash, but it does mean expectations are already priced in. Then there's the Buffett indicator, market cap relative to GDP. Historically, when this gets stretched to these levels, forward returns tend to compress. Again, not a timing tool, but a warning signal about long-term positioning. And finally, market cycles. It's been roughly 4 years since the last major drawdown. And historically, prolonged calm periods like this often lead to sharper corrections later. Not because of a single trigger, but because risk quietly builds underneath. But here's the key point. None of this tells you when the next bear market starts. What it tells you is something more important. We're likely closer to the end of the cycle than the beginning, and that changes everything. So in this video, I'm going to break down how I would actually approach the next bear market, where I would look for opportunities, how I would think about risk. This is how I'd make money when the market turns. But here's the part most people miss. The real driver in every cycle isn't just valuations, it's retail behavior and where the money is actually flowing. And in the last bull market, a huge chunk of that money flooded into one platform more than any other, Robinhood. Low friction, mobile-first, gamified trading turned millions of regular people into hyperactive traders almost overnight. In a raging bull market, that created insane volume and momentum. But when the bear market hits, that whole dynamic flips, volume collapses, risk appetite evaporates, engagement drops hard. And that's exactly where the next set of opportunities and dangers shows up. So in the rest of this video, I'm going to explain exactly why I think Robinhood will be one of the best opportunities if a bear market comes. I'll also show you whether it's actually a good stock to buy right now, and I'll run a full DCF valuation so you can see exactly what I think the fair value is today. So what does Robinhood actually do? Robinhood is a free trading app, stocks, options, crypto. But it only works because of one thing, activity. The more you trade, the more they make. This entire business runs on activity. When markets are hot, people are glued to their phones, opening accounts, trading daily, taking risks. Robinhood's revenue explodes, the stock follows. When markets tank, people freeze. Nobody wants to trade a falling portfolio. Volume collapses, revenue drops, and Robinhood stock gets hit harder than the market itself. Robinhood today has a market cap of around $62 billion and a beta of roughly 2.46. It moves significantly more than the market itself. And that's exactly where the opportunity lies. A fair question here is, why focus on a name like Robinhood instead of something like the Magnificent Seven? Because yes, in a bear market, almost everything gets cheaper. But not everything behaves the same. Large cap tech tends to be more resilient, stronger balance sheets, more diversified revenue, longer-term capital. But names like this are different. This is a high beta, retail-driven business. That means when market conditions are strong, it benefits disproportionately. But when liquidity tightens and risk appetite drops, it also compresses much faster. And that volatility is exactly the point. Because what falls harder often has more room to recover when conditions reverse. Now, this is where things get interesting. If you look at Robinhood, it's a highly cyclical business. Revenue is heavily tied to user activity, trading volume, options, overall engagement. So when the market is strong, everything expands. But when conditions shift, that changes very quickly. As the market turned more bearish, activity slowed down and revenue followed. It's a clear example of how sensitive this business is to market conditions. And because of that, I'd expect a significant drop in revenue again in the next downturn, and the market will likely react to that. Now, looking at growth expectations. For Robinhood, analysts are projecting around 17.6% annual revenue growth over the next 2 years. On the earnings side, forward EPS growth is about 13.4% and roughly 15.4% longer term. So nothing extraordinary, but still solid double-digit growth. Since Robinhood became consistently profitable, its average PE has been around 49. Right now, it's closer to 33. So yes, it's lower than it used to be, but that doesn't necessarily mean the stock is cheap. It just means it's cheaper. Same story on a forward basis. For Robinhood, forward PE averaged around 39, and now it's closer to 32. So again, lower, but not necessarily cheap. Now on profitability. Robinhood is fundamentally a capital-light business. Gross margins are exceptional, around 95%. Operating margins are currently about 46.8%. And net margins around 42%. And the key point here is the trend. Margins are steadily improving over time. Now, if you pull up Robinhood's free cash flow chart, it has declined significantly. But here's why it's completely irrelevant for this business. Robinhood is essentially a brokerage. And when a brokerage grows fast, two things balloon on the balance sheet: securities borrowed and user receivables. We're talking billions of dollars tied up as the platform scales. That hits the cash flow statement as a massive outflow. But it's not money being burned, it's the business getting bigger. More users, more assets, more lending activity. Now, looking at returns. For Robinhood, return on invested capital is currently around 10.8%. Not the strongest and slightly down from around 13% last year. But what matters more is the trend. Back in 2022, returns were actually negative. And since then, we've seen a clear improvement. So while it's not exceptional yet, it does show the business is moving in the right direction. Moving on to the DCF. All the assumptions are laid out here. In a base case, I get a price of around $51.9. In a bull case, about $71.4. And in a bear case, roughly $37.1. That gives a weighted target price of around $53.3, which implies about 23% downside from current levels. So based on a DCF, the stock looks overvalued right now. Using an EV to EBITDA exit multiple approach, the 5-year price comes out to around 66.5 in the base case, about 84.8 in the bull case, and roughly 49.6 in the bear case. That gives a weighted price of around 66.9, which translates to slightly negative returns from today. So both methods point to the same conclusion. Robinhood looks overvalued at current prices. But I'm not looking to buy it here. I'm only interested if we get a real market downturn. Now, looking at sensitivity analysis. In my base case, I'm using an exit PE of 25. In the bull case, 30, and in the bear case, 20. For growth, I assume around 15% annually in the base case, broadly in line with analyst expectations, 18% in the bull case, and 12% in the bear case. I'm also targeting a 15% annual return over 5 years, and applying a 10% margin of safety. Based on that, the entry price comes out to around $46 in the base case, about $63 in the bull case, and roughly $32 in the bear case. At current prices, that would imply returns of around 8% in the base case, 15% in the bull case, and less than 1% in the bear case. So on a weighted basis, the entry price is closer to $47, which is meaningfully below where the stock trades today. So once again, the conclusion is consistent. Robinhood doesn't look particularly attractive at current valuation. If we look at the sensitivity table, what we see is how returns change across different assumptions, both in terms of growth and exit multiples. But the key idea here is the entry price, because in a real bear market, revenue for Robinhood would likely decline, and multiples would compress at the same time. And given this is a high beta name, a 20% drop in the broader market could translate into something much larger here. A 40 to 50% decline isn't unrealistic. Not guaranteed, but definitely possible. So if the stock drops to around 35, returns start to look very different, at around 15% long-term growth, in line with analyst expectations. Even with a conservative multiple of 18, you're looking at roughly 16% annual returns. And if the multiple moves closer to 30, still below current levels, that's closer to 28 to 29% per year over 5 years. And if the entry is even lower, say around 30, the picture improves even further. At the same 15% growth and a multiple of 18, you're already looking at around 20% annual returns. So at those levels, the asymmetry becomes very compelling. So putting it all together, at current valuations, I don't see Robinhood as an attractive investment. Both the DCF and multiple-based approaches suggest limited upside or even downside from here. But that doesn't mean I'm ignoring it. This is definitely a name on my watch list. For all the reasons we've discussed: high beta, strong operating leverage, and sensitivity to the cycle. So if we do get a real market downturn, this is one of the first names I'll be watching closely. And if the price drops into that $30 to $35 range, that's where it becomes very interesting to me. But above 35, I'm probably staying on the sidelines. If you found this useful, consider subscribing, and I'll see you in the next one.